Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
All right, let's talk about one of the most exciting and, let's be honest, dangerous things you can do in business: starting a company with a partner. It can be the thing that launches you into the stratosphere, or it can be the fastest way to lose not just your business, but a great friend too. So, how do you make sure you get it right? So if you're thinking about starting a business with a friend, hold on. Before you start dreaming up logos or drafting a business plan, there is one absolutely fundamental question you have to answer first. Because what looks like a simple team-up is actually a minefield of unspoken expectations. So in this explainer, we're going to walk through the 5 critical stages of building a partnership that actually lasts. We'll start with the dream versus the reality. Then we'll get into what your contributions are really worth. After that, we'll figure out who's actually in charge, ask if you're even cut out for this in the first place, and finally, lock it all down in writing. Okay, so first up, why do we even partner up? Well, it usually boils down to one of 2 things, right? Either you need cash and investment to get your idea off the ground, or you need someone who has skills that you just don't. On paper, it makes perfect sense. But here is the hard truth, the reality check. Most partnerships, they just don't make it. And look, it's almost never because one person is malicious or has bad intentions. The real killers? A lack of clarity and expectations that are totally out of whack. These little misunderstandings don't just sink the business, they can absolutely destroy friendships. And that brings us right to the first major trap, the money. As soon as people start talking about a partnership, the conversation almost always goes straight to cash, equity, and how to split the profits. And this is exactly where the first big mistake is usually made. I mean, this is such a classic scenario. You hear it all the time. You just look at the money each person puts in and assume the ownership should be split the exact same way. It seems totally logical, doesn't it? But thinking like this misses a massive piece of the puzzle. Here's the thing you have to get. Value comes in 2 forms. The tangible stuff is easy. That's the cash, the equipment, things you can literally touch. But then there's the intangible stuff, your expertise, your contacts, your sheer hard work, the brand you've built. That stuff is just as valuable, if not more. And that's why you have to figure out a value for that know-how and both agree on it before you do anything else. So what does this word equity really even mean? It's a concept that's global, right? It's not just your slice of the pie when it comes to money. It's actually a bundle of rights that you and your partner get to define. So does your 20% equity mean you get 20% of the vote or 20% of the company's assets if you sell? The answer is, it means whatever you both agree it means in your contract. And this idea leads perfectly into our next point. Once you realize that equity is totally flexible, you can start to separate the idea of ownership from the practical, day-to-day running of the business. This is where you get into the real nuts and bolts of how things are going to work. Just look at how much flexibility you have here. You can decide to split profits after you've paid all the bills, like rent and salaries, or you could do it before. You can also pay someone a salary on top of their share of the profits. You can even set up different rules for how you split profits versus how you split losses. It's all on the table. And this might be the most important concept to really let sink in. You could have a 20% financial stake in the company, but negotiate to have 50% of the voting rights when it comes to big decisions. If you're the one with the expertise, the one who knows how to actually run the thing, you can and probably should argue for more control, no matter how much cash you put in. Okay. We've talked about the business, the money, the power, but honestly, none of that is going to matter if the people involved just aren't compatible. So before you even start to think about a potential partner, you have to start with yourself, and you have to be brutally honest. No, really, think about it. Are you the kind of person who absolutely needs to have the final say? Or are you genuinely okay with building a consensus, even if it's slow, and even if you sometimes disagree with where it ends up? What's your natural instinct? Are you a let's just try it and see what happens kind of person? Or do you need to get everyone to agree before you make a move? There's no right or wrong answer here, but if you and your partner are opposites, it can cause constant friction. And here's a big one. When things go south, and trust me, they will, are you the type of person to take ownership and say, my fault? Or do you immediately start looking for other reasons things went wrong? How you both answer this can decide whether your business survives a crisis. So once you've taken that hard look in the mirror, you have to turn that same brutally honest lens on your potential partner. Do they really have the skills that you're missing? How committed are they? I mean, does their level of desperation to make this succeed match yours? And based on what you now know about yourself, are your work styles actually going to be compatible? So if you've gone through all that, you've assessed yourself, you've assessed your partner, and you've decided you're going to do this thing, there is only one way to protect your business and to protect your relationship. You have to write it all down. This really gets to the heart of the matter. There's this wonderful Korean phrase, ishim junshim, which basically means understanding each other mind to mind without needing words. It's a beautiful idea for a friendship, but in business, it is an absolute recipe for disaster. Assuming your partner just gets it or knows what you're thinking will cause conflict. Every single time. Think of your partnership agreement as your roadmap. It has to spell out exactly who does what. It has to state the value you both agreed on for all contributions, the cash and the know-how. It needs to detail how you make decisions, how you split profits and losses. And this is so important. It has to have a plan for the future. What happens if someone wants out, or if you want to bring someone new in? So as we wrap this up, the final question you have to ask yourself is this. Are you building your business on the shaky, unstable ground of assumptions and feelings? Or are you building it on the solid foundation of clear, written agreements? Because the success of your company, and probably your friendship, is going to depend entirely on that answer.